Just a quick comment, on RIO and BHP, which I did speak about last week, but we do have an add on both. We do obviously prefer BHP, which I went through last week, but I just want to talk about them again briefly, just heading into reporting season. Both of them look in great shape this reporting season. Everyone's across the strength of earnings and cash flow. Obviously, very healthy half we've had for bulk commodities, which is their major exposures for both of them. Especially iron ore, but really just looking at it from a dividend point of view, starting off with Rio, free cash flow for this calendar year on our estimates, which is similar to consensus, is around $7.5 billion of free cash flow. You then add in the Coal and Allied sale, which is in its final stages now. Shareholders have just approved it. That's just over another $2.5 billion. That gives them free cash flow or after capex and all investment of just over $10 billion US, or in Aussie dollars per share, $7.50 per share. You compare that to the fact that their gearing is only 17%, so that's well below their target gearing of 20 to 30%. So balance sheet's in great shape, and the fact that they also have no big capex items coming up for sanctioning. There's no big expenditure on the horizon. And then you compare that then to the fact that consensus for this year's dividend is only $2.50 per share. So $7.50 of cash flow with nothing really to do with it versus $2.50 of consensus dividend estimates. So really, they could comfortably pay out $9 billion in dividends this year and buybacks versus consensus at $4.5 billion. So that's double consensus, and you'd get a dividend yield of 9%. So to me, going to August, Rio in particular for this reporting season, thanks to that Coal and Allied sale, they're going to look in great shape for that big dividend, and I think that's where the market will start to focus next. Not currently a big topic. So BHP, similar position, not quite as strong. Their free cash flow, $11 billion over the next 12 months versus consensus dividend of $4.6 billion. So again, their gearing is a little bit higher at 22%. So assuming that they pay down some additional debt or conserve cash, they could still comfortably pay a big dividend, high case of $7 billion, or that's Aussie dollars, $1.75 per share, which would put them on a dividend yield of close to 7.5%. So I'm not saying they'll both max the dividends to that extent, but I certainly think they'll comfortably trounce consensus, and just think that that's going to be a real re-rating story for both stocks. Just as you get a bit of indecision in the market about what commodity prices are doing. And I think it's taken some of the focus away from how strong the big dividends will be from these two going into this reporting season, which was a real thematic already in the February results, and we saw good share price re-ratings on the back of that. And I just think that they're really going to put the pedal to the floor now, and you're going to get a good re-rating event in August when they both report. So just wanted to reiterate, we've got to buy on both. More than happy to back that in. And just think there's plenty of legs there beyond valuation that would see that both of these companies supported.